Welcome to Angel Impact, the official podcast of the Wisconsin River Business Angels. Episode 7, Overview of the Strategy and Appeal of Angel Investing, Part 1. Hi, this is Aaron Marks, and I'm here with the latest episode of Angel Impact. And Angel Impact is the official investing podcast of the WRBA, which is the Wisconsin River Business Angels. And the Wisconsin River Business Angels is Central Wisconsin's only angel investment group. And I'm here with the leadership of the WRBA. I'm here with Jeff Ebel. Jeff is the president. Say hello, Jeff.
Hello, Jeff.
And Jeff has a good sense of humor. I don't know. You have to get to know him a little bit. It's earthy, we like to say. Yeah. And sometimes you have to get to know him a little bit for it to come out. But there's an illustrative example. And then I'm also here with Leon Ostrowski, and Leon is the chair of the WRBA. Say hello, Leon.
How you doing, Aaron? Greetings to the people out there as well.
Yeah, I'm doing well, and it's a pleasure to be with both of you today. And this is going to be a great episode. I know. So when we were preparing for it, I could feel the passion and enthusiasm, and there's going to be a lot of dense information here. But I think if you're interested in investing in entrepreneurship, you're going to find it very interesting, and I certainly did. And I'm learning a lot from this episode personally. So. So we're calling this a high-level view of angel investing strategy, and we're going to explore just a lot of facets about angel investing in a high level of detail, and kind of give clarity about how it works, what it means, how it's different from other related kind of concepts. So I think the question we're going to start off with is, what is the difference between equity and debt financing of a business? And either of you can pick that one up.
Yeah, I'll take that one if that's all right.
Yeah.
I work with a lot of entrepreneurs through my presenting of the entrepreneurship training program. Most of those businesses would be lifestyle businesses, which are very important to local economies. But they do make up some 95% or even more of the businesses that are out there. The small businesses, they would meet the definition of SBA's small business, which is under 500 employees. Most of them are considerably less than that. But almost all of those businesses would consider financing their business through debt financing. Debt financing is your typical bank loan. It is you borrow the money that you need to get your business started or to grow it, and it's paid back with interest, either on a monthly basis or sometimes annually, depends whatever terms you set up. But the lender does not own any of your business. They usually will ask for security. If you have stuff, they want it, and that kind of assures them that they're going to get their money back. On the other hand, equity financing is where investors, different types of investors we'll be talking about, can provide the capital that you need to start or grow your business in exchange for a percentage of ownership in your business. There are no debts to pay back. There's usually no interest payments. That's calculated in a completely different manner. As a part owner of the business, you are entitled to part of the profits of the business. But typically, equity investors would get their money out when there is either an investment round, a bigger investment round, where bigger investors, and I know that we'll be talking about the different types of investors coming in, where bigger money comes in and will take out some of the smaller investors. And it's usually at a considerable increase in value. And that's what I think some of the early investors are looking for. But equity investors own part of the business. They may or may not want to be involved in operating the business, where that could be very unsuitable for some owners that want to have total control over the business. That wouldn't be appropriate. But typically, I'd say well less than 5%, maybe in the 1 or 2, 3% of businesses out there would really be suitable for this type of funding for their business.
Yeah. Well, yeah, that was great. And already, there's so much we could say about these different things. And I know that like Shark Tank is something that's really, kind of put equity financing in the public imagination and the understanding lately. And that is the kind of financing that angel investing deals with. So the next thing we thought might be helpful is if we could, kind of parse out some distinctions between some different equity investing kind of concepts and practices and strategies that I think a lot of people probably kind of conflate in their mind. That is, they all sort of see them as maybe sort of part of the same nebulous thing. And Leon, I think this might be a good question to pitch to you. So, could you could you describe the differences between angel investing, venture capital, and then what you call private equity family offices?
Okay. Let me go back to what Jeff talked about when he said lifestyle businesses. That first money that many of these companies have to start with is their own personal savings or their family's savings or their friends making loans to them. After they've consumed that and they've got a business that's going to potentially generate product or service that goes to a broader audience rather than the local community, then the angel investors will typically be more interested in it. This is not investing typically in real estate. It could be, but it's not normally. That's a different type of investing. And the banks can usually help you out there. But what we want to get into is the types of investings that sort of fall into the angel investing category. That's the next group of people. These are people that are interested in helping grow a community, helping grow a specific industry, and helping grow their personal wealth. They want to invest in the company and provide some of their experience as an angel investor. Angel investors are typically early in the game. There may not be any sales yet in the company. There could be, but that's sort of two different levels of sales from those companies, lack or with some. But then you start getting into, say, a smaller amount of money, but a lot of more projects. Then the venture capitals come in after that. They will pick it up from the angel investors, add a lot more capital, but a much fewer projects. So when you get done with the local economy, and maybe more the national economy, they both generate comparable numbers of dollars. Only one's got a ratio of 80-20 and the other one's got 20-80, so you can sort of see how the money goes and grows. And then you end up with private offices can function in either one of those. It's just somebody has a pretty high net worth and they're going to build their staff and run this operation themselves. And they will decide what the criteria are they want to invest in. And they will find candidates. And all three of these can work together on the same opportunity. It depends on where they are in the process. Typically, they're starting to move towards sales and you start getting more of those involved. Angels tend to be earlier in the game. As a result of that, they get a higher return on their investment. They accept the higher risk. And that's sort of the nature of the game.
Yeah.
And Aaron, another way to look at it is there is a continuum of financing for businesses, starting from concept, the idea, and you usually, like Leon said, you're going to invest your own money, maybe some friends, some family. There may be some grants that can help you finish your research and your development, product development. But there are stages that a company goes through as it grows. And at each one of those stages, there may be need for capital. And as you grow your business, you're going to be looking to different sources for that capital. Angels play a very unique role in that there is uh, a segment in that continuum of funding they call the death zone, dead zone. And that's where people typically will not invest money, or it's very hard to get people to invest money. The company doesn't have assets, so bank typically debt financing wouldn't go there. It's too small for venture capitalists and maybe private equity people to get in, and that's a space typically where angel investors play. They provide that gap between maybe the research grant money and actually launching the business where they're generating revenue and generating sales. Now, as you look at that continuum, you're going to find that various groups play in the various areas in that continuum, but there's a lot of overlap. So angels might take you this far. VCs might come in here. They might come in before angels are out, but they'll come in. They'll definitely stay in long after. They provide a lot bigger dollars. So to understand that continuum of financing for a company is important to understand exactly where angel investors play.
Let
Yeah.
me take that one step further. You take the angel investors, they decide typically what projects they want to invest in. Okay. They're selecting from the offerings that the organization will make of all their portfolio projects. Whereas when you get into a private equity, they have pre-selected that through their management team. You decide to put X number of dollars into the pot, and and then they will take that dollars and allocate it to the projects that their management team decides, and you get the returns on there. And of course the family office, provides their own monies into those projects. So it's really one where the investor has opportunities to select where they do not in the other.
Yeah, awesome. Okay, well that's a really great high level view of angel investing. And actually, Jeff and Leon don't know this, but I'm going to make an executive decision right now to end episode 1 of this short series right now, and kind of put an ending on part 1 of this high level overview of angel investing. So we're gonna record the second one in just a bit here, and then release that as its own episode. So I've been here with Jeff Ebel. Jeff is the president of the WRBA, and Leon Ostrowski. He's the chair of the WRBA, and my name is Aaron Marks, and this has been Angel Impact. We'll see you next time.
Thanks, Aaron.
Thanks.
Thanks for listening to Angel Impact, the official podcast of the Wisconsin River Business Angels. To learn more about the Wisconsin River Business Angels, visit the website at www.midwestwealthventures.com or find us on Facebook.